Hello everyone, I'm Ravi Handa and welcome to another episode of Desi Fire podcast. In today's episode, I'm going to talk about investing in real estate. Now, the problem with the discussion around real estate that at least I have noticed is that it is very anecdotal in nature. People talk about how they made money in real estate or how they lost money in real estate, how they booked a flat in Noida which they never got, or how they bought some land on the outskirts of Nagpur which has become 10x in 10 years. And our decision making is often linked to what sort of anecdotes we hear. And that's how I see a lot of discourse on YouTube as well, where people are talking about their personal experiences, something that they have heard, and not too much looking at the data. The reason is that the data does not exist in a very nice format, but I've done some digging, and this is what I have figured out in terms of returns that you can expect on real estate in India. And when I talk about returns, that is just one of the factors in decision making whether you should invest or you shouldn't invest. But let's first have a look at the numbers. At least we should have an idea about what to expect from real estate. So let's begin. The first set of data that I looked at was from the National Housing Banks. It's called the Residex. It's sort of an index that has been developed, and it tracks the price change in the residential housing properties. So this only takes care of your residential properties, so that means your flats, your houses, etc. It does not talk about land. And they collect this data from sub-registrar offices. They also collect this data from banks because suppose you take a loan, they do some sort of a valuation for that. And they also collect this data through a market survey. So that means this data is fairly comprehensive. Not only that, they collect it for a total of 50 cities, that is 50, and the data from 2013 is available for you to download and check it out yourself. Just search for Residex and you should be able to find that information for all cities. They have it for 50 cities, 50 cities right now. And what does the data tell us? So it tells us that for the period from 2013 to 2023, that's the 10-year period, the returns, if you want to look at it, they have been close to 5%. The 4.9% annualized, that has been the sort of returns that you would have got. Good or bad, I'm not commenting on that. That's just what the data shows. It gives us that the absolute returns on an average have been 62.7%. Median returns have been 61.3%. The maximum return has been 134%. So that means the best case scenario, if you had invested in the best possible city, your money would be roughly 2.5 times of what it was 10 years ago. Is that good or bad? Once again, no judgment, but that's what the facts are. And there have been cases where you have made a 0% return over the last 10 years as well. So that is also a possibility that you should be prepared for, that over a 10-year period, there is a city where people haven't really made any returns in the 13 to 23 period. But the other part which I want to highlight, which is often said about real estate as well, is at least you don't lose money. You don't, have the case of, let's say, in some of the other instruments where you put in money and you lose 30%, 40% in 6 months. That happens. In some cases, you even lose the initial capital. Your 100% loss also happens. But those sort of things are rare in case of real estate. What the data was given for a total of 43 quarters. So Residex measures it every quarter and it does an indexing of that. Out of a total of 43 quarters, if you look at quarter and quarter change, only in 8 quarters was the price down. So that means that even if if you look at longation of periods, obviously you're not going to lose money on real estate. But even quarter on quarter, there is only a 20% chance of you losing money. That's really low if you look at some of the other assets where you beat inflation, such as stocks or gold, etc. We will talk about the comparison a little bit later, but the point that I want to emphasize here is that it is fairly stable in nature. The worst case scenario, 19 was the 19 out of 43. So even in the worst case scenario, less than half of the quarters were bad, and the minimum was just 2 quarters at negative returns. So this data is spread over 50 cities. What were the top cities? The top 3 cities in this particular period, that is 2013 to 2023, to invest have been Hyderabad, Patna, and Ahmedabad. These are the 3 cities that have given us the maximum amount of returns, and the bottom 3 have been Faridabad, Bhiwadi, and Delhi. So that's fairly NCR concentrated region where people haven't made that much money in the last decade or so. So that's 2013 to 2023 end. The data is till December 2023. Some of the other city rankings that I was interested in, Newtown, Kolkata. My in-laws are from there, so that has a ranking of 12 out of 50. Bangalore has been 15 out of 50, so it is definitely an above average performer. Pune has been 17 out of 50. Jaipur hasn't done that well, so Jaipur is out of the 50 cities that were ranked. I live in Jaipur, 38th position, so Jaipur real estate hasn't done well. Gurgaon is at rank 43, so Gurgaon has done even worse. The point that you need to understand is that when we talk about real estate investing, someone who invested in Gurgaon would have had a very, very different experience from someone who invested in Hyderabad, because there is a large variance that exists. And this was the data from NHB, which does fairly robust data keeping, but just one data set. I looked at another data set which is done by ISB, the Indian School of Business, in collaboration with housing.com. They looked at only, I believe, so they only looked at the flats and residential sort of data, and they have come up with something called the Housing Price Index. This Housing Price Index tracks data from 2017 till 2024, so this is fairly well updated. And once again, a company like Housing is behind it and people from ISB are behind it, so you can't really question the authenticity of this data, or even the NHB one that's used for policy making, and that's fairly robust in terms of data collection. And what does this data tell us? So if you just look at the graph, so to say, which it sort of fits with what I've heard from my friends, that 2017 and so on, it went on okay, it was climbing a little till, let's say, 2022. That is when the line seems to have jumped and the prices have started climbing, and late 2023 or mid 2023 is when there is a real big bump that you can see here. So the last few years, the last 2-3 years have been really good for real estate, which is indicated. And they have also data on 1 BHK, 2 BHK and 3 BHK, but I'm not very sure which color is which here. The red one is the overall returns one. So 2017 to 2024, overall in India, if you want to look at the returns, an absolute of 32% and an annualized yield of roughly 4.04% is the sort of returns that you have got. Hyderabad has been the best, once again here, as well as the NHB Residex both said Hyderabad has been the best performer in terms of real estate, where you have gotten a return of 8.5% roughly. Hyderabad 1 BHK, that has been the best performer, which has given which has roughly doubled your money, because you have gotten a more than 100% returns here, or roughly 10.5% annualized returns is what you have got from Hyderabad. And NCR 2 BHK, they have been the worst performer, where you have gotten just 2.5% returns. So I have friends who got 2 BHKs in NCR, and it does sound very similar to what I have heard from them as well. So that's essentially the data for the residential part. Then the other argument that comes in is you can look at commercial property as well, and you can look at land as well. For commercial property, there are REITs which are available, but again, very new, not that much data is available. And for land, when I wanted to look at it, I did not really find too much around land prices in various cities, but I did find something from IIM Ahmedabad and S Farms, which is the Agri Land Price Index. Fairly new, it got started only in January 2019, so it has data till 2023 September, so just a 4.5 year period, but it does give us some insights on agri land prices, and there the returns have been significantly better. So again, we are just looking at a very, very small period right now. Even the folks who made this, they also said that please don't use this to extrapolate because this is very, very small data. The land that they are looking at, once again, is not really land in city, it's agri land, and the data that they have considered is the average distance from the nearest airport. In Delhi it is 15 kilometers, but if you go to something like Rajasthan, they are considering places which are 100 kilometers from the nearest airport. So it's not really city land or something that maybe you can build a farmhouse or something on that, but even that would be too much if it is 50 kilometers from the city. These are the distances from the city here. The point being, this is not city land, this is agri land, which has essentially given us a 14.3% returns. So that's around the returns for India. But as you would have realized by now that there is not too much data, there is not very reliable data that exists. We have indicative data, and the indicative data is giving us somewhere around a 5% sort of returns over a decade sort of period for residential property. But to make a judgment on whether real estate works, how it works, should you invest or not, I would prefer looking at slightly longer term, because very rarely do you buy land for 5 years or 10 years. Most people hold it for a lot longer. And that is why it is important to look at global returns. Now, the benefit of looking at global returns is they give you a very long period. So I looked at the US real estate market, the Case-Shiller index, that's where this data is from. So they have the data going back to 1928. So that's just before the Great Depression began till 2023. So this is over 95, 96 odd years is what we have the data for. The average returns have been around 4.5%. The median returns have been around 3.85%. The annualized returns, I think this is the number that we should be looking at that's most accurate, in my opinion. Nothing is accurate. This is probably something more realistic to expect. The annualized returns have been 4.23%. If you look at the last 50 years, things look slightly better with 5.5%, the median being 6% and annualized being again 5.5%. Last 10 years have been good, where the average has been 7% roughly, and the annualized yield also has been 7%. So, but broadly speaking, 4.5 to 6 is what you should be comfortable with when you talk about the returns on real estate. But this is real estate in the US. India might be different. So instead of just looking at what real estate returns are, I thought it would be a lot better if we looked at something called real returns. What real returns means is how much has it beaten inflation by. I got this data from Ashwath Damodaran's website, who is a fairly well respected name in the financial sector. He is a professor of finance at NYU. The data is available on his website. You can go there and download it and check it for yourself. Now, what he looked at is real returns. What he found out was that if you look at the long-term 96-year period, the real estate has given a real return of around 1.25%. Over the last 50 years, it has been 1.6%. Over the last 10 years, it has been 4.16%. But the idea is that it has beaten inflation fairly comfortably over very, very large periods as well. However, if you look at the same thing, and that's why I kept this as an option, because equity markets or gold are considered some of the other key assets that people use to beat inflation over the long term. The S&P beats it by a much larger and a much bigger margin, which is around 8.5%, or in the last 10 years, it has been close to 10%. Even gold does a very good job of beating inflation over the really long-term period of 90 years and 40, 50 years, and even over the last 10-year period. One more thing that I wanted to look at was the stability of returns in this period. So we are talking about a 96-year period. In this 96-year period, number of years where S&P 500 had given negative returns was 26, which is sort of expected. Equity is supposed to be volatile. Number of years where real estate had given negative returns was just 15. That makes it fairly stable. The other part, which sort of came as a shocker to me, because I thought that gold is also very, very stable as an asset, but gold had more negative years even when you compare it with equity. So gold gave negative returns in 34 years out of the last 96-year period. However, there is another thing that you need to look at is it's not just that they gave negative returns, it is also how much negative returns they gave. So S&P 500 on an average in a negative year did minus 13.5%, whereas real estate even in the 15, so A, it falls less number of times, and B, it falls in amount terms, it falls very less, so that's a minus 4.5%, where even gold on an average when it falls around 7.5%. So once again, real estate has proven to be fairly stable in terms of returns. So this is the data in terms of returns. Now, what are the other factors that you need to consider in your decision making? Mathematical factors, rental yield. The rental yield, because when we are talking about returns, we are talking about the price of the property. There is also an element of rental that you can get, which can be anywhere from 2 to 4%. This is the only instrument in India which allows you leverage that you can take a loan and invest in real estate. You will not get a loan to invest in gold. You will not get a loan to invest in the equity markets, and huge amount of loans you can get. Say, let's say if you're willing to put down maybe 15 lakh rupees and you have a pretty decent salary, you can get a loan of, I don't know, maybe 75, 80 lakh rupees. People buy 1 crore homes like that. You cannot do that with other stuff. The amount of tax benefits that are there in buying real estate are huge. I don't understand it why they are there, but they are there. The government has a very strong push towards pushing real estate as an asset class. You get tax waivers on home loan. The interest that you are paying, that gets a tax waiver. The principal you are paying, that gets a tax waiver. Even while registration, you have to pay something which is known as the registration or the stamp duty, which can be, in Rajasthan it's 7-8%, depending you are a male or a female, varies from state to state. You can get tax benefits on that as well. So this is essentially an additional cost. This is the negative, but all of these are positive for real estate. There's something which is the standard deduction. If you put property on rent, you can claim some money as expenses on that property and reduce your tax liability. Then there are sections like 54F, which allow you to avoid paying capital gains tax in a lot of scenarios. So huge chunk of tax benefits exists in the real estate sector, which play a very important role in decision making on whether you should invest in real estate or you should not. So you cannot just look at just returns, you also need to consider these. And yes, the stamp duty can be 7%, 8% in a lot of states, and that takes away a chunk of whatever returns you are expecting. And sometimes I have seen that people, they plan for a 1 crore property and they realize that, there is an additional 10 lakh that will need to be paid in terms of registration and broker fees. Puts them in a slightly awkward situation sometimes. So these are some of the things that you need to consider, so to say, before you actually make that investment. The non-mathematical factors which should be considered before making an investment: liquidity. You cannot sell your house or your flat, just like that. Finding the right buyer, finding the right price, finding the right ratio of black and white money, that's a reality which exists in India, can be a problem. Now, you are not comfortable with black money, and if you're selling a 1 crore flat, the buyer does not want to pay more than 70 lakh in white because he'll have to pay stamp duty on that 70 lakh rupees. If he gives you that 30 lakh rupees, what are you going to do with it? And a lot of people I know have those issues when they are actually going to sell property. So you need to keep that in mind. That's how the market is. Tenant management is also a very big issue in India. Not just because finding a tenant can be problematic, but the sort of tenant that you get, the sort of behavior that tenant has, and some uncle in the neighborhood might have a problem with it. So you might not find a tenant for a few months, or you can get into a problematic situation where the tenant refuses to vacate. These are not one in a million stories. These are very real, everyday stories which happen. A lot of the real estate transactions, a lot of real estate in India is fairly unregulated. You can't really go to one particular builder and buy the flat and assume that I went there, I would have bought it at the same price. Which any other financial instrument, if you think about it, in India is fairly regulated. The price that you pay and the price that I pay would be very similar. Not true in case of real estate because it's fairly unregulated. So these are, some of the problematic non-mathematical factors which exist. But in my opinion, the two most important factors that should swing your decision making one way or the other. So let's say if you're fairly convinced based on returns or the other mathematical factors, that you're going one way or the other, good enough. But the two most important factors which I believe everyone should consider before investing in real estate is, one is saving habit. A lot of people I know, I was like that myself as well, that when I started earning, I didn't really save that much. I saved a little. And a lot of people do tend to spend more than they should. Once you buy a house, once your EMI starts, then, it's a compulsion. You have to save. But no, I will do SIPs. Fair enough. If you are that disciplined, then the saving habit factor doesn't make that much of a difference to you. But not everyone is. And I would argue that majority of the people that I know can very easily find 50,000 rupees for their EMI versus 50,000 rupees for investing in the stock market, so to say, every month. It's a psychological thing, and a lot of finance is based on how you behave, which might or might not be rational all the time. Then the other thing is the single asset problem, which I like to call it. When you are buying real estate, you're buying just one particular unit in one particular society or in one particular city or in one particular area. What happens to the entire city or the entire country or entire area might or might not happen for you. But the single asset thing is a huge problem because you're not able to diversify. When you invest in any other asset class, your money, it might be a huge amount of money, but it gets distributed into various instruments. Let's say if you're investing into equity, then what you would do is you would invest it in X, Y, Z companies' shares. Let's say you're buying bonds, then you will buy bonds from various banks or various companies. You are able to diversify your assets. In real estate, you cannot do that. Until and unless you have so much money that you will buy 3 flats here and 5 flats there and stuff like that, you cannot really diversify in real estate. And how that one single unit does, that would define your financial journey, and that becomes too much of a risk, too much reliance on one particular unit. So these are some of the factors that you should consider, and which gets me to the conclusion that, okay, what are we supposed to do? So this is the end part of it as to what are we supposed to do. What I've done is I've defined 5 broad purposes for which people buy real estate, and then given my opinion about it. If it is for consumption, by consumption I mean that you're going to live in it for, let's say, 5 years or 10 years or any period more than 5 years, I think that's a fairly good idea to buy a house or a flat or whatever you want to buy. It's a huge psychological benefit. There is no doubt about it. At least I sleep very peacefully knowing that I own the house that I live in. There is also a social benefit to it which you cannot deny. Whether you own a home or not, that is, in India, it's still, the biggest status symbol that there can be. If you're considering it from the perspective of asset allocation, I do believe, once again, it's a very good asset to have in your portfolio, as long as it is maybe 20%, 25%, 30% of your portfolio. If your real estate is 80% of your portfolio, then it is no longer an asset allocation play. But if it is, let's say, 30%, 40%, 20%, 50%, anything less than 50%, I think it's a good play, because it gives you very stable returns over the long run, and it beats inflation over the long run. That is essentially what you want from one of the assets in your asset class, that okay, it's stable also and it's giving me a little bit of returns as well. If your goal is capital protection, now there can be a scenario where you do have a large amount of money and you don't really want to put it in any sort of risky asset, whereas you still want to beat inflation over the long term. Then yes, real estate is probably the way to go about that, because the value doesn't fall that much. It will be there for the long term. You can pass it on to the next generation. The capital that you have created will remain protected over the long term. If your goal is cash flow generation, a lot of people do believe that, okay, we'll buy a flat, put it on rent, and that will form a cash flow based upon which I would retire. That, I think, is a very poor idea. The rental yields are low and the appreciation is not that great. What your purpose is should define whether you should invest in real estate or not. And that is why, if your purpose is to generate cash flows, then it's a very poor asset. You need to go towards bonds in that case, or FDs, or anything which gives you a fixed sort of return. If you are a senior citizen, SCSS, Senior Citizen Savings Schemes, is a great idea. If you're not that old, then you probably don't need cash flow because you have salary coming in. So think about that. Think about what your cash flow needs are, and then take a call on whether you need real estate or not. But I don't really think that for cash flow, buying real estate will be a good idea. It's actually a very poor idea, in my opinion, if you are buying it just for cash flow. If you're buying it for long-term growth, I'll say it's okay. A lot depends on your luck, because it's a single asset thing, how that single asset performs. But broadly, it's okay, because most real estate will beat inflation over the long term and provide you with some real returns. But if long-term growth is what you're chasing, I would very strongly recommend that you go ahead with equities, because as I think we saw in one of the slides as well, over the long term, if growth is your idea, if in beating inflation by a big margin is what you're looking for, nothing is better than equities for that particular goal. So that's pretty much it. I hope this video will help you make an informed decision about real estate whenever you want to buy. And if not, at least when you are talking about it in a party, you will be able to talk in a much more sensible fashion about real estate, instead of saying that, Handa bought that particular property and it has become 5x in the last 10 years. And on that note, I'd like to wrap up this video. Thank you everyone for watching. Please remember to like, share, comment, subscribe, and everything else. Hope I have earned the privilege of your time. Thank you.